Dear subscribers, as you know, we shared many information for you, and we are studying very hard to find current news for you. However, I cannot use this channel for future. Please follow our new channel called as Daily News Report and watch our video to support us. Link in description. Also, you can reach the video we shared on Daily News Report by clicking on the top right button. We highly recommend watching, subscribing, and sharing. We will continue to share some news on this channel, but we take precautions against some situations for future. Thank you for supporting us.
Days, and there was a young lady named Isabella Kaminska, and the name of the video is Gold, Our Dangerous Obsession. If you don't mind, I'd like to read you just a little bit from the video and then get your take on it.
Sure.
And there's a sociologist, Nigel Dodd, and he thinks gold is a poor form of money because it is antisocial. And quote, gold expresses a wastage of human potential, and that's what gold really is. It's human waste. Poo, that is made to shine. If you're in love with gold, you're in love with your own poo. He also said gold undermines the fundamental point of what money should be. If you were sitting across from the table from Mr. Nigel Dodd, what would you have to say to him?
Well, first of all, I have seen that video. In fact, I thought it was so hilarious. A lot of people took offense at it. I just thought it was so bad. It was funny. It was laughable. So I've been tweeting it out, putting it on my Twitter feed at James G. Rickards. And I'm just looking at my metrics. I've had over 1,500 views just from my Twitter feed. Now, I'm sure there are tens of thousands coming in from all over the world, but I just from my own Twitter feed, there are 1,500 people who have looked at it. Look, here's the thing. Isabel Kaminski is a fine reporter. The Financial Times is a fine newspaper. Yeah, they do what they're told, right? She went out and did this. And actually, I thought the production value was very high. Somebody spent a lot of money making this video, but the content was hilariously bad and wrong. And I talk about, I hadn't obviously seen this video when I wrote my book, The New Case for Gold, but nevertheless, a lot of the arguments seen in the video are ones that I completely knocked down in The New Case for Gold. So people should watch it for a laugh, but it's also, there's a serious side to it, which is this video is from the Financial Times is a perfect example of the miseducation, the conditioning, I'll even go so far as to say brainwashing about gold that has taken place. And a lot of things people think they know about gold are completely wrong. The important things that you should know about gold are very much unknown to most people. You and I and the listeners of this program may be familiar with it, but believe me, most Americans, even a lot of people around the world, are not. And that's actually why I wrote the book. You know, I had the two bestsellers you mentioned, Currency Wars 2011 and The Death of Money in 2014. I had a chapter on gold in Currency Wars, and I had two chapters on gold in The Death of Money. But frankly, Rory, I got to a point I said, you know what, I need to sit down and take everything I know and I've learned and I've researched and I've discovered about gold, put it all in one place. The content is technically high level, but it's plain English. It's meant to be totally accessible. Any American or any citizen can pick it up and read it in an evening. It's not that long and get through it. And I said, I've got to put this all in one place because there's just too much nonsense. And I was getting fed up, candidly, with these arguments against gold that don't hold water. But you hear them all the time. I was on television did an interview on Bloomberg TV with Joe Weisenthal. He's one of their anchors. Joe starts out by calling gold a pile of rocks. I said, Joe, it's not a rock, it's a metal. So why don't we start there? But you hear these things. People say, well, you know, you can't have a gold standard because there's not enough gold in the world to support the money supply. Well, that's nonsense. There's always enough gold. You just have to get the price right. At $1,200 an ounce, it would be deflationary. At $10,000 an ounce, that would work extremely well. So the quantity of gold is not an impediment to the gold standard. But if you want one that works, you have to be honest about the real value of paper currency. And you would have to have $10,000 an ounce or higher to make it work. Now, I'm not saying there's going to be a gold standard tomorrow. I'm just saying in the next financial panic, Central banks don't want a gold standard, but they may have to go to gold to restore confidence. If they do, I promise you the price will be $10,000 an ounce or considerably higher, because it has to be that to avoid deflation, which is the central banker's worst enemy. So, and then there's another one that says the supply of gold does not grow fast enough to support the growth of the world economy. Well, they look at mining output, which is about 1.6% a year. And they look at the growth of the global economy, which is about 3% a year. And they say, see, mining outputs, gold's only growing at 1.6%, and world growth with paper money is 3%. So the gold supply is not growing fast enough to support the growth. That's ridiculous because it fails to distinguish between official gold and private gold. In other words, the official gold, that's the gold that could theoretically support the money supply. That's what central banks and finance ministries and the IMF and other official institutions have. The global economy grows at 3%, but if you want to grow, but mining output is irrelevant. If you want to grow the official gold supply, all you have to do is print money and buy it. In other words, buy it in from the private supply into the official supply. You can grow the gold supply as fast as you want to support world growth. So mining output is a red herring. I mean, I know what mining output is. It's about 1.6% a year, but that's no constraint on the growth of official gold. Just go buy it from the private sector. So, Rory, don't get me started, but these are just two examples of things you hear all the time. Gold's a rock, which it's not. Gold can't support money supply, which is not true because there's plenty of gold. You just have to get the price right. Gold doesn't grow fast enough to support world growth. Nonsense, because you can buy private gold if you want to grow the money supply faster. So all the things people think they know about gold are false. I shoot them down one by one in the book. But I watched this, very, very well produced video from the Financial Times. I go, here we go again with all the nonsense. By the way, there was one interesting figure in that video. Professor Sella, if you recall the video, he was the chemist. And he was not a gold basher. He's just a scientist. He was talking about how the gold atom is actually fairly densely packed. It didn't interact with other metals or solvents. That's part of the case in favor of gold. I actually quote him in my book, The New Case for Gold, because, why is gold money? Well, there are plenty of good reasons why gold is money, but one of them is, what else could be money? You're not going to want something that's radioactive. You're not going to want something that dissolves in water. You're not going to want something that, is impossibly scarce. You want it to be scarce, but not too scarce. You don't want a gas that'll go up in the sky. In other words, Sella takes the periodic table of the elements, goes one by one, disqualifies all of them for different reasons, except gold, and reaches the conclusion that gold is the only one suitable for money. Now, that's not a complete argument, but it's a pretty good start to understanding why gold is money. And he is, they do interview him in the video. So it was nice to see some thoughtful commentary, but poor Isabella, she's a smart reporter. I'm sure she's a nice person, but she got lured into this, gold bashing thing. And it's just all this pop psychology about anal retentive, antisocial behavior. Look, here's the thing.
Yes.
The antisocial behavior is not coming from people. It's coming from the central banks. They're the ones lying to us. They're the ones who are non-transparent. They're the ones who are manipulating the money supply, manipulating our expectations behind the scenes. They're the ones who are destroying trust. So I agree that in a society where you could have sound money without gold. I mean, it's possible. It just never happens because the central bankers want to manipulate it for the benefit of the power elites and enrich themselves at our expense. And so the social contract is broken. I agree with that, but it wasn't broken by the people. It was broken by the elites.
Exactly. If gold is a pet rock, if it's a tradition, why are the central banks so secretive about it? Why would they not open the doors to the to the New York Federal Reserve? Why would they not open the doors to Fort Knox and say, here's an audit, here's what we have, here's what it looks like? But they don't do that. So that leaves us to speculate on what is or is not there. So I agree with that. I mean, if you want to talk about antisocial, they're the ones that are being antisocial, not you and I.
Correct. And by the way, Rory, your point that gold is a tradition. Who said that? That was Ben Bernanke.
Exactly.
He was doing an interview, I think, with some students at George Washington University, and somebody very intelligently said, Chairman Bernanke, if gold is such a worthless thing, how come the United States has 8,000 tons? How come the IMF has 2,000 tons, on and on. Why are all these central banks and IMF and official institutions holding thousands of tons of gold if it's not a monetary asset? And Bernanke said, oh, it's a tradition, kind of blew it off. But, I actually spoke to Ben Bernanke about this personally, one-on-one, and I read his book. He made his scholarly reputation long before he went on the central bank. As a scholar, he was famous for studying the Great Depression in the footsteps of Milton Friedman and Anna Schwartz, who were probably the greatest scholars of the Great Depression. And so I read his book and I met him and had a nice conversation. And his book actually says that gold was never a constraint on the money supply in the Great Depression. I mean, how many times have you heard it said, gold caused the Great Depression, or we could have got out of the Great Depression if we weren't on the gold standard, if only we had elastic money supply, we could have got out. You've heard that over and over. It's just not true. But the reason I know it's not true is Bernanke's own research. The law at the time, in the early 1930s, the law was that the money supply could not be more than 2.5 times the value of gold at $20 an ounce. So take all the gold that the Fed had the gold at the time. Take the gold that the Fed had, valued at $20 an ounce, multiply by 2.5. That was the maximum amount of the money supply. Bernanke showed that the money supply never exceeded 100%. It could have been 250%. 2.5 times, but it never exceeded 100%. In other words, the Federal Reserve could have doubled the money supply in the Great Depression, still remained on the gold standard, and still obeyed the law. Gold was never a constraint on the money supply. The constraint was the banks and the people. Nobody wanted to lend. Nobody wanted to borrow. Velocity was plummeting. These are all monetary phenomena, which are all true today, by the way, that had nothing to do with gold. So gold never acted, that the failure was not gold. It was discretionary monetary policy by the Federal Reserve. They failed to increase the money supply. Now, that Bernanke had no problem with that. He quadrupled the money supply between 2008 and 2014 with QE1, QE2, and QE3. But the point is, gold was never a problem. And so anyway, I met Bernanke. I had his book with me. I asked him to autograph it. He very kindly autographed it, personalized it. That was very nice of him. And I said, Mr. Chairman, I just want to understand. I've read your research. My understanding is that you're saying that gold was not a constraint on the money supply during the Great Depression. Do I have that right? And he said, yes, you do. So I got it straight from the horse's mouth that gold was not the problem. And yet he goes in front of the students and says it's a tradition, as a way of disparaging gold. So, and I've spoken to other members of the Board of Governors of the Federal Reserve. I've spoken to regional reserve bank presidents. I've spoken to Nobel Prize winners, the top people at the IMF. I mean, I've just had all these conversations. What they tell you privately and what they say publicly are two different things.
Yep. I've heard that before, and from other guests that I've interviewed. And I want to kind of look a little more globally, if you don't mind, Jim. And China, Russia, and all of the nations these two countries are aligning with, primarily through the Shanghai Cooperation Organization, the SCO. And the SCO represents approximately 70% of global commodities and approximately 50+% of global population. What impact will these massive organization of nations have on commodities and, more importantly, on the American economy?
Well, Rory, first of all, I think you're very wise to focus on the SCO, the Shanghai Cooperation Organization. It's a lot more important than, the BRICS Bank and all that. I mean, BRICS Bank is kind of yesterday's news. Not that important, actually. China created the BRICS Bank as a lever to get more votes at the IMF. Well, guess what? They got the votes. Last December, Paul Ryan slid a hidden clause, a hidden provision in the budget bill. The budget bill itself was a disaster, but in the middle of this big budget bill, he slides in this authorization for the IMF to increase the voting rights of China, which they did. So China got what they wanted. So they're going to turn their back on the BRICS Bank because they would rather play in the IMF, which is a much more important organization. But the Shanghai Cooperation Organization is powerful because it's not just a financial arrangement. In fact, it's not even primarily a financial arrangement, although that's part of what they do. It's also a military, strategic, infrastructure, and commodities organization that includes Russia, China primarily, but also, Mongolia, Kazakhstan, a lot of nations throughout Central Asia. And what they're doing is reconnecting what's called the heartland, the Eurasian landmass, from the Middle East to Vladivostok and from Rotterdam to Vietnam, building highways, railroads, tunnels, airports, other connections, increasing natural gas pipelines, oil pipelines, building up, and they're basically bypassing the sea lanes. Now, when Asia is divided, you have to move transportation and strategic resources, and for that matter, money via sea lanes. And the United States controls the sea lanes through the United States Navy. We've done that for really 100 years at this point. Before that, it was the Royal Navy. But if you can build that network, that infrastructure network in Asia, then you don't need the sea lanes. You could take a rail car, you can load it in Shanghai, take it by rail to Rotterdam, right? All the way across China, Russia, Siberia, Central Asia, Eastern Europe, Western Europe. You don't need to ship it. And so that's what the Shanghai Cooperation Organization is doing. But the other thing they're doing is acquiring gold. China has acquired thousands of tons. Russia has acquired over 1,000 tons. Kazakhstan has acquired gold. By the way, I just got a very nice letter from the Prime Minister of Kazakhstan addressed to me personally. It was transmitted through the Kazakhstan embassy to the United States, which the Prime Minister said very, very complimentary things about my first book, Currency Wars. I'm sending him a personalized copy of my new book, The New Case for Gold. So I was honored to receive that, but it shows that, people are paying attention, and I would definitely keep my eye on the Shanghai Cooperation Organization.
I've been following that for a couple of years now, and actually about a year ago I did a really nice roundtable focusing just on the Shanghai Cooperation Organization, and I had three people who were very well studied in what's happening there, and what was happening at that time, I should say, or up to that point. And it worked out really well. And you mentioned Kazakhstan a couple of times, and a financial, I'm going to quote, this is from The Verge, and Koos Jansen over at Bullion Star picked it up and wrote an article around this. And it's a financial delegation from Kazakhstan visited the Shanghai Gold Exchange to discuss cooperation in gold trading along One Belt, One Road, also known as the New Silk Road, that reaches over the whole Eurasian continent. And that ties in with what you were just saying. And it sounds to me like, Jim, that all of this gold that Russia and China have been acquiring, and Kazakhstan, I've learned, has tripled their gold holdings within the last 5 years. They've gone from about 75 tons all the way up to about 225 tons. And now we learned that Kazakhstan is in communication directly with the Shanghai Gold Exchange, discussing openly gold trade along the New Silk Road. I mean, how is that going to, are these guys working on a gold standard, or is the New Silk Road, is it going to work through the SDR? Is the SDR basket going to have some gold involved in it? Or what's going on with that from your perspective?
Well, I think a number of things are going on. And Rory, the way I would put it is that the Chinese are too smart, and the Russians are also too smart to put a stake in the ground and say, here's what we want to do. What they're doing is keeping their options open. So on the one hand, they want to play in the Big Ten. The Big Ten is the IMF and the special drawing right. But right now, that's dominated by the United States. The United States has veto power over significant motions in the IMF. The U.S. has the largest voting bloc, the largest so-called quota, et cetera. Now, China is increasing its stake on, as you know, the IMF at the end of November 2015 voted to include the Chinese yuan in the basket that's used to calculate the value of the SDR. I should just explain to you what the SDR is. The SDR stands for Special Drawing Right. Sounds geeky. I know a lot of PhDs who can't give you a straight answer on what it is, but it's actually incredibly simple. The special drawing right is world money. They don't want to call it world money because it's a little spooky sounding, but that's what it is. Exactly. Now, the Federal Reserve can print dollars, the European Central Bank can print euros, and the IMF can print SDRs. So it's just another form of fiat money printed by the IMF. By the way, you say, well, who's in charge of the IMF? They have a 24-member executive committee, 24 nations. You look at that list, you got kings, dictators, communists. It's a nice group of people. You've got some democratically elected leaders too. It's not all dictators, but it's a nice crowd. Completely unaccountable, self-perpetuating, unelected. They're just there. So they run the IMF, and basically they operate through the G20. And a lot of people think that because there's this basket that the SDR is backed up by a basket of hard currencies. It's not. It's just another fiat currency. Well, what's the role of the basket? The role of the basket is just a math problem to determine the value of the SDR expressed in other currencies. So you say, well, what's an SDR worth? Well, right now, one SDR is worth about $1.45. I receive an email from the IMF every morning giving me an updated valuation on the SDR. It's about $1.45. I've seen it as high as $1.55, as low as $1.35. It's just another exchange rate. It's like saying the euro. The euro went from $1.45 to $1.05 various times over the course of the past 5 years. Well, then sure, it's a floating exchange rate. Same with the SDR. So including the Chinese yuan in the basket of 5 currencies, it's dollars, euros, yen, sterling, and now the Chinese yuan. That's a prestige thing. It's important. It's meaningful. But it doesn't change the fact that the SDR is just another printed currency. So China's in that club. They got more votes at the IMF thanks to Paul Ryan, so they're in that club as well. And they want to stay in the club. But here's the point, Rory. When the next financial crisis comes, and I can see it a mile away. It's coming. It's going to be worse than 2008. We don't necessarily have time to go into all the science behind that, but it has to do with risk being an exponential function of system scale and the system getting larger. So that's just a matter of time, and probably not very much time. But when it happens, it's going to be bigger than the central banks. You go back to the last two. 1998, the world was hours away from every stock and bond exchange in the world closing. That was the Ltcm crisis. I know that because I was there. I was the general counsel of Ltcm. I negotiated the bailout. I was on the phone with the Fed. The treasurer was in the room. I talked to the CEOs of Goldman Sachs and all the major banks. So I know we were just hours away from every stock and bond exchange in the world closing. At least temporarily, and we avoided that by the last minute bailout. Now, come forward to 2008. We all know what happened there. Lehman, AIG, same thing, hours away from sequential collapse of all the major banks in the world, bailed out by the central banks. But look at the sequence. In 98, the banks bailed out a hedge fund. In 2008, the central banks bailed out Wall Street. So 98, Wall Street bailed out a hedge fund. In 2008, the central banks bailed out Wall Street. In the next crisis, possibly 2018, if we keep up this 10-year tempo, who's going to bail out the central banks? Each one gets bigger than the one before. Who's bigger than the central banks? The answer is the IMF. They have the only clean balance sheet left in the world. They're going to print trillions of SDRs, flood the zone. The Fed's not going to be the Fed took their balance sheet from $800 billion to $4 trillion in the last bailout,
Yep.
But they haven't reversed it. They haven't normalized it. They're not back down to where they started. They're still at the $4 trillion. What are they going to do the next time? Go to $8 trillion, $12 trillion? They can't. I mean, legally they can, but they're at the outer limit of confidence. So the only source of new money without destroying confidence in theory is the IMF. They're going to issue the SDRs. But they're going to need China's support to do that because China has a bigger voice. And China's quid pro quo is fine. Let's issue the SDRs, but now the dollar is no longer the global reserve currency. The dollar will be like a Mexican peso. It'll be used locally inside the United States, but it won't be the benchmark for the world. It'll be the SDR. So China, the Chinese yuan is not ready to be a global reserve currency, but the Chinese and the Russians don't like the dollar as the global reserve currency because it gives the U.S. too much power. So the solution is use the SDR as the global reserve currency. And by the way, when you sit down at that poker game to cut that deal, your chips in the poker game are going to be the amount of gold you have. So that's why China's getting gold, Russia's getting gold, our friends in Kazakhstan are getting gold. Get your gold now. And I just say to investors, hey, if it's good enough for China, it's good enough for me.
What I tell my wife is, if we do what wealthy people do, then we have a much better opportunity of being wealthy. And the Chinese nation, in my opinion, is one of the wealthiest nations in the world right now, based on the volume of gold that they have.
Sure. The two wealthiest nations, the two largest economies and among the wealthiest nations in the world are the United States and China. U.S. has 8,000 tons. China has 5,000 tons on their way to 8,000 tons. Clearly, China's trying to catch up with the United States. So if they're sitting on all this gold, maybe you should have some too.
And last question, Jim, and it ties in with what you were just saying, and you just published a piece this morning titled "The Limits of Monetary Policy Have Been Reached," and that was published over at Daily Reckoning. And what I wanted to ask you about is NIRP, the negative interest rate policy. And with several countries already moving towards a cashless society and digitized currencies, and all the talk of a cashless society here in the U.S., from my perspective, this would be the mechanism to implement a negative interest rate policy. Will the other nations around the world participate, or how do you see a cashless society unfolding, and what does it mean for gold?
Well, you can have a cashless society without negative interest rates, but it's difficult to have negative interest rates without a cashless society.
Exactly.
Negative interest rates, obviously, are when you put your money in the bank, you come back a year later, and some of the money is missing. The bank took it away. That's a negative interest rate. Instead of paying you interest, they take the interest away. They take it from you as if you were a borrower rather than a depositor. So your money disappears. So people say, well, that's easy. I can get around that. I'll just take my money out of the bank, stick it in a coffee can, bury it in my backyard, stick it under my bed, whatever. By the way, talk to your grandparents. My mother and my children's grandmother, and most listeners' grandparents remember the Great Depression. They remember these kinds of things going on. But here's the problem. So the power elite know that cash is a way to get out from under negative interest rates. So they're trying to make cash disappear, trying to force everyone into digital bank accounts. So imagine you run a slaughterhouse and your job is to kill all the pigs and cows. What do you do first? Well, you round them up into pens. You don't run around chasing cows. You herd them into pens and then you slaughter them. That's what's happening to savers and investors. We're being herded into these digital pens at a small number of mega banks, and then we'll be slaughtered with negative interest rates. So people go, I'm going to escape from the pen by getting some cash. My answer to that is good luck. You won't be able to do it. People ask me about the war on cash all the time, and I say, look, the war on cash is over, and the government won. Like, you think you can get cash. It's not illegal, but try doing it. Go down to your bank tomorrow and ask them for $5,000 in $100 bills. Say, give me a stack of $50, $100 bills. You will be treated like a criminal, a terrorist, or a drug dealer, or a tax evader. They will ask you for identification. Some banks will say, come back in a couple of days, as if you got to get your cash by appointment. They'll file, if it's 10,000 or more, they'll file what's called a CTR, a currency transaction report with the government. But even if it's under $10,000, they'll file what's called an SAR, a suspicious activity report, because they say, hey, you never came in for cash before. You're doing it now. What's up with that? That's suspicious. So, and by the way, the bank tellers are trained to not give you the benefit of the doubt. Don't treat you like an innocent civilian who's trying to avoid having your money stolen by negative interest rates. Treat you like a drug dealer, a terrorist, or a tax evader, or else they lose their job because they've got bank compliance officers and federal examiners looking over their shoulders. So the whole system is where you think you can get cash, but you actually can't. Go to an ATM, take out $1,000, try taking out another 1,000. They'll say, sorry, you're up to your daily limit. And by the way, those can be reprogrammed down to $300 for gas and groceries. The government will say, hey, who needs more than $300 a day for gas and groceries? That's plenty. So the war on cash is over. The government won. You can't get your cash. You're locked into this slaughterhouse, this digital slaughterhouse, and they're going to pick your pocket. One of the reasons I like gold is because it is legal to go take your money and buy some gold. Then you put that, you're not subject to hacking. You're not subject to digital attack. You're not subject to negative interest rates. And if the gold goes up in value, you don't have to pay any income tax unless you sell it. Now, if you sell it, yeah, you got to declare that and pay income tax on it. But if you're holding the gold and it goes from $1,000 to $2,000 to $5,000, which it will, you don't have to pay any income tax on that. Just sit on the gold, as I say, until you sell it. And you never have to sell it. You can, leave it to your kids in your will. But what you're doing is you're preserving wealth. You're protecting yourself against the inflation slaughterhouse, the negative interest rate slaughterhouse, and the digital slaughterhouse. That's where we're all being led. The way to jump over the fence and be free range is to have some gold.
Exactly. Get some gold, especially while you still can, because I don't think it's going to be available very much longer. Not because anybody's going to take it away from us. I just think that there's a finite amount, and the miners have been in trouble for the past few years, and they can only take so much before they start shutting down, which they've been shutting down. So that in itself will hurt supplies.
Well, that's absolutely right, Rory. I just got back from Switzerland, and I met with the head of the world's largest gold refinery. And now, so what does a gold refinery do? They take gold in the front door, they refine it and ship it out the back door. They basically take gold in three forms: what's called doré, straight from the mines; scrap, which is rings, necklaces, etc. And then they take gold, but it's maybe 2 nines, 99% pure gold in these old gnarly 400-ounce bars. They refine it into 4 nines. That's 99.99% pure 1 kilo bars, which is the new global standard set by China. So my friend knows who all the sellers are, and he knows who all the buyers are. I'm talking physical gold. I'm not talking paper gold, COMEX futures. I'm not talking about any of that. I'm talking about physical gold. He buys it and he refines it and he sells it. So he knows who the buyers are. He knows who the sellers are. He said from the point of view of his buyers, he cannot meet the demand. They want to buy twice as much gold as he can produce. He's working his plant 24 hours a day. He cannot produce it fast enough. On the buying side, from his perspective, he cannot source the gold. He's seeing shortages. He's having difficulty getting gold in the front door. So he's got more demand than he can meet. Supply is drying up. So the physical shortages are already there today. What do you think is going to happen in the financial panic? What do you think is going to happen when the price of gold goes up? You're not going to be able to get it. I talk to investors all the time. People say, well, I hear you, Jim. I think you're right, but I'm going to wait till it takes off, and then I'm going to go get my gold. Or, call me the day before as if I'm actually going to know, and let me know, and I'll sell my stocks and buy gold. Sorry. When that happens, you're not going to be able to get it. Your local dealer is going to be back ordered. The mint's going to be not taking new orders. Maybe some central banks and hedge funds will get some, but you won't. So all the more reason, what are you waiting for? Get your gold today.
Get it today. I mean, and the way I look at it is if there's a 0.01% of investment dollars that were to shift from paper assets, equities, and so forth into physical gold, it would completely annihilate the system right now. It would be impossible to get.
That's right. Yeah, it's not like people got lots and lots of gold and we're looking for more. The truth is most people don't have any gold. I was, again, on my recent trip to Switzerland, I was also at an investment conference, and I happened to share a driver. We shared a car from the airport in Zurich to the place where the conference was. And my seatmate in the car was the head of the pension fund for Colombia, for the nation of Colombia. So he ran they have a funded pension plan, so like Social Security, but they actually put real money in it, unlike our Social Security. And so he managed all that money. It's about $50 billion. And I just said, how much gold do you have? And he said 0. So, I wasn't being critical of him, but the data is people don't have gold. So the point being, yeah, if they even move the needle a tiny bit, I mean, I recommend 10% gold. I don't recommend going all in. I recommend 10%. But if it even went from 1% to 2%, which is tiny, there's not enough gold in the world at anywhere near these prices to supply that demand. That by itself would put gold at $5,000 an ounce. You don't need a gold standard. All you really need is just a small uptick in demand, and the price will double and triple in a short period of time. So this is coming. You can see it a mile away. When it comes, you can watch the price of gold go up on television, but you're not going to be able to get any. The time to get it is now.
Exactly.